Hi, welcome. It's Mary Ellen McGonigal, Senior Managing Director of Equities here at Simpler Trading with your weekly Edge show for Friday, March 10th. Today, we are going to go ahead and take a look at where the markets closed for the week. And as always, what you need to be on the lookout for going forward. Also, we are going to take a look at some of those headline news that drove price action this week. It was a very negative period, and I will share with you some of the more primary reasons for the deterioration in the markets this week. Last up, viewer question of the week, and it's all about how you can get more defensive in this market and other areas as well. So let's take a look at some of that data that drove price action this week. First up, earlier in the week, Fed Chair Powell did testify in front of the Senate and the House. His comments during that time did point to elevated interest rates going forward, primarily because inflation remains high. It remains sticky. That was not good news for the markets. Rising rates are a negative. So that did provide the initial deterioration at the beginning of the week. From there, on Wednesday, we did get news that private sector job growth picked up in February, and this is another negative point simply because the Federal Reserve wants employment to be reduced, and thereby spending among consumers will go down, and all in an effort to help inflation drop. So this was another heavy point for the markets to digest. We did see deterioration there. And then also relating to China, there was news that they may propose another lockdown due to a flu epidemic. It has not come to pass, but the news was enough to push certain areas of the market lower. We'll get into that. Also, on Friday, strong U.S. job gains in February. However, the unemployment rate did rise. So at the end of the day, there were potentially some bright spots that economists were able to point to in those employment numbers. However, the overarching news was the collapse of SBV Financial, and that in turn really drove the markets quite a bit lower Thursday into Friday. Next week, another important week, we will get core CPI data on Tuesday. This is a very important inflation metric paid very close attention to by the Federal Reserve. And then beyond, also retail sales and industrial production numbers are going to be released next week as well. So from here, let's go ahead and take a look at those markets and see where did we close for the week. And here we are. This is a daily price chart of the S&P 500. A couple of very important things to note is that the momentum, in this case, this RSI indicator, is below 50 in negative territory. Also, the stochastics, this is a faster moving momentum indicator, is in negative territory. Now, the stochastics are oversold, and we can use history as a guide. Be on the lookout for a potential rally. Also, the RSI is close to being oversold if it gets down below that 30 level. And again, you can use history as your guide. You will see periodic rallies from these oversold positions. But from here, let's go ahead and take a look at the NASDAQ and see where we closed. But also before that, I did want to point out that the S&P has now broken below these key areas of support. That would be your 50-day and your 200-day moving averages, and also the fact that this distribution or this selling is occurring on above average volume, which is indicating distribution, not what you want to see. Your next possible area of support for the S&P 500 will be your lows here in that late December period. From here, we can take a look at the tech-heavy NASDAQ composite, and we can see that it too has negative momentum with the RSI, also the stochastics, and we have closed below this 50-day simple moving average. Very important information there, breaking key support. The reason is your next area of downside support is going to be back here again in that late December period, but quite a distance lower. So we will keep an eye on that, of course. But at this point in time, both indexes are in a downtrend. So with the NASDAQ, I will share with you now a longer term daily price chart view. And what I'm highlighting here is the fact that when you get a negative RSI on the NASDAQ, in combination with a negative stochastics, oftentimes historically, using these periods here as precedents, you will see further deterioration beyond that. At this point in time, the NASDAQ has pulled back over 9% from that early February peak. And if we go back historically, we can see on average, it does appear that we do have further downside potential ahead. So from here, we're going to take a look at the 11 underlying sectors in the S&P 500. Really helpful to get a sense of where there may be relative outperformance. I added an RSI indicator. These ETFs are listed in descending order so that your relatively stronger areas are up here in the forefront and then weaker areas down here in this lower quadrant. So first up, taking a look here at technology. It actually outperformed the markets last week. This is XLK. You can see negative momentum certainly on that RSI, but overall the group held in relatively well. I'll share with you the areas of strength there as we move forward. And then other areas of note is the fact that, of course, financials continued to deteriorate. Huge drop last week, all about SVB, and then other banks as well that had been struggling due to the inverted yield curve and other characteristics. Also of note is the fact that utilities and staples, they're kind of up here in the forefront. We did see relative outperformance from these sectors as well. But overall of note is the fact that they are very much in a downtrend. It's not an area where I would load up simply because they are defensive. The overall group is most certainly in a downtrend. One other area that we can take a look at here in looking at these various broader market sectors is the very significant decline that took place in basic materials stocks. This is an area that had been a big outperformer, certainly last week, and this drop in the materials is primarily due to that news that China is maybe considering another lockdown. This rally last week in materials was all about China's very strong manufacturing data, which in turn really boosted steel, aluminum, other materials related stocks, and the news of a lockdown really negated that and then some. From here, we're going to take a look beyond those sectors at some of the sub-industry groupings. Again, a 2-month daily price chart view and rate it by relative outperformance. So first up here is volatility. VIX did spike all the way up to that 29 level. It did decline as today, on Friday, as the day progressed, but unfortunately that volatility did close up above this blue 200-day simple moving average. Historically, a close above that implies increased or higher volatility from here with your momentum now in positive territory. Rising volatility is a negative backdrop for the broader markets. Let's take a look at another outperformer, and this is GLD, the gold ETF. This is all about a flight to safety. Given SVB's collapse and certainly the decline in the broader markets, we can see upside positive momentum here in this ETF. Also up here in the forefront is, I talked about technology outperforming. One of the areas that did outperform were semiconductor stocks. Now, certainly they declined with the markets, but not as much, certainly, as other areas. Your MACD still in positive territory and just a dip below this neutral on that RSI, so that certainly is notable. Also from here, another area that did drop sharply today is the yield on that 10-year treasury. Take a look. We had a 6% drop today, after the yield had been approaching that 4% level. And the reason here again is flight to quality, people exiting the stock market and entering into the safer haven of U.S. Treasury bonds. Other areas of note here that we can take a look at here is the fact that small cap and biotech stocks that had been underperforming really came under selling pressure this week. This is IWM, the Russell 2000 ETF, and we can see the sharp drop here, and an escape or an exit from small cap stocks really highlights the risk off sentiment among investors. Also of note is the fact that the Russell 2000 has a lot in the way of smaller bank stocks that are a part of that index. Another sharp drop here in biotechnology. This is IBB, the NASDAQ Biotech ETF. This is another riskier area of the market simply because most biotech stocks do not have earnings, and we can see this sharp drop here also signaling risk off among investors as they sell stocks in these areas. Now, of course, the biggest drop this week is going to be KRE. This is that regional banking ETF. Of note is the fact that KRE, the RSI up here, is now below 30 in an oversold position. We'll get a little bit more into that, but certainly the MACD down at that lowest quartile in anticipation of some sort of a potential bounce in some of these bank stocks, because certainly not all banks are in the position that SVB was because of their narrow focus of customer base and other characteristics that are not evident in other banks. So from here, let's go ahead and take a look at a chart of KRE, and I'm taking us back to this 2020 bear market period and what the group looked like ultimately coming out of this bear market that took place. KRE, a lot of these bank stocks really dropped significantly simply because at the beginning stages of the lockdown, there was no sense of the impact. Would there be a lot in the way of loan defaults? And without growth and with individuals locked down, would there be a need for loans where many of these regional banks derive most of their profit margins? So I will tell you, going into the fall period of 2020, we finally did break above this key area of resistance and move to an uptrend here. I recall it very clearly because at this point in time we were adding bank stocks. This was all about earnings. The banks were coming in with negative earnings but well above estimates, and also much of the fear of default were behind us as it was not shaping up. The group did go on to very great heights beyond that. So at this point in time, I'm not in any way anticipating this length of time for a recovery, but most notably pointing out the fact that there will be news of stabilization within the group, the fact that the common denominators for SVB are not widespread, so be on the lookout for a turnaround. But the ultimate point too is the fact that we do have that inverted yield curve that will continue to create downward pressure on these bank stocks. Another area I did want to highlight to you, I talked about technology outperforming, and a reason or part of that is the fact that solar related stocks did fare well last week. Alternative energy equipment stocks are actually part of the technology sector. So from here, I did mention that I would share with you defensive areas that could be utilized as a way to hedge. We talked about gold, GLD. From here, I will share with you two consumer staples stocks that are looking really quite healthy, and this is Hershey, HSY, of course, the chocolate manufacturer. I'm highlighting this stock because this period here, they did come in with very strong numbers, and management guided their growth prospects high going into the remainder of this year. The stock has been able to remain above these shorter-term moving averages, with the outside momentum indicators remaining in positive territory. The company also offers a 1.8% yield, which is another buffer. One other consumer staple name that you can keep in mind here is Altria Group. MO is the ticker symbol. It is a tobacco-related company. And this particular stock, I'm going to go ahead and pull up what's called a full quote here and highlight that they offer a 7.9% yield. But more importantly is this pop on strong earnings, the stock remaining above these key moving averages, and the momentum generally in positive territory. For those not familiar with my MEM Edge twice weekly report, I urge you to use that button below to trial it. I will be alerting subscribers very regularly to the market dynamics, what to be on the lookout for, and then also areas that you can remain in despite deterioration shaping up elsewhere. I'm going to leave it there. Everyone have a fantastic weekend. I'm going to look for you here again next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.